Well, good afternoon. My name's Houston Bruck. I work in the Farm Loan Programs Division of the FSA headquarters team. And I'd like to just begin by thanking you all for joining this important webinar briefing on the Enhancing Program Access and Delivery for Farm Loans rule. We're excited to introduce this rule that was published today in the Federal Register, and it introduces some important improvements to farm loan programs. And today, our goal isn't to make everyone experts in these changes, but rather to introduce you, our valuable lending partners, to some of these changes and the guiding principles within these policy updates. This rule is over 100 pages long. There's a lot of changes in it, and you'll see there's been a link to these slides posted in the Q&A, and you can grab those. And there's I believe a link in the slide to the Federal Register. Now we'll put that in the Q&A if you haven't already seen it. So it's a big rule. There's a lot there, and we wanted to make this opportunity available for y'all to just summarize what some of the bigger changes are and directly how some of these changes may impact the guaranteed loan program. So again, not going to make you all experts, but just introduce you to these changes that we believe just equitably increase access and opportunities for farmers and ranchers that we all serve. As a reminder, this is a Microsoft Teams live event, and those are recorded sessions, and they'll be posted on the Lender's Toolkit on the FSA website for future reference. You could also access the recording just by clicking the same link that you used to access this event. The recording will be available there too. If you need to step away a bit, feel free to push the pause feature in Teams, and that'll be your ability to go take a break and come on back. We do think we've got about 40 minutes, 25 minutes. We'll see exactly how long it takes us to get through here, but that's about the length of the content we've got today. So if we go over a little bit, if you're expecting this to end right at 30 minutes, feel free to pause it and come back later if you'd like. That's totally appropriate. We do have the ability to ask questions in the Q&A that can be anonymized if you'd like, and we'll take a look at those and answer things if there's logistical questions that we can answer within the Q&A. But if there are content questions and we can't answer them either in this training, or another format, just individually with you, then we'll be sure to cover those things at future trainings, maybe at our next webinar event here coming up in a month or so. We'll want to start out here with just showing you a 3-minute video that we think does a pretty decent job of summarizing the theme and the scope of these changes. So we'll give that a watch, and we'll jump right into some introductory comments from our Deputy Administrator before going into some of the specifics. So got about a 3-minute video here. We'll give that a watch.
USDA's Farm Service Agency is committed to helping America's farmers and ranchers thrive. And sometimes that means changing the way we do business. So this year, we're making big changes to our farm loan programs. Changes that'll help our customers more easily access credit, meet their financial goals, overcome unexpected setbacks, and plan for the future. Here are the 3 biggest changes we're making. First, all customers can now work with FSA to create a business plan designed to help them save for emergencies, retirement, education, and capital investments. We're also helping our direct loan customers increase their savings by offering more flexible repayment terms, like starting with smaller interest-only payments and longer loan terms that provide more time to repay. Next, we've lowered our security requirements in a way that benefits our customers and protects taxpayer resources. Previously, most direct loan applicants had to pledge available collateral up to 150% of the loan amount. That's dropping to 125%, which means less land, crops, and equipment will be tied up securing FSA loans and can be used instead to access capital from other lenders. We've also removed the requirement that customers pledge their primary residence as additional collateral at the time a loan is made. And after establishing a history of on-time payments, we'll release liens on collateral that customers provided as additional security. Finally, we're expanding options for existing borrowers who experience financial distress. Previously, most distressed borrowers had to navigate a lengthy application process to defer an upcoming payment to the end of the loan. We've simplified and shortened that process, and we'll provide a lower interest rate on the deferred payment. Those are 3 of the biggest changes, but we've made other updates too, including broader loan eligibility, expanded emergency loan access, and additional flexibilities on direct loan security requirements. These changes are designed to empower agricultural producers to improve their financial security today, so they're better prepared for the future. And financially stronger farmers and ranchers translates to stronger communities, resulting in a more vibrant and sustainable agricultural economy. We're proud to make these changes so we can better serve our customers, lenders, and partners, and continue helping America's farmers and ranchers achieve financial freedom and resilience for generations to come. These changes to FSA's farm loan programs are detailed in the Federal Register as the Enhancing Program Access and Delivery of Farm Loans Rule. For more information or to apply for a farm loan, go to farmers.gov/loans.
All right, well, we think that video does a good job of giving a snapshot of what we're doing within this regulation change and why, but I'm going to go to our Deputy Administrator, Bill Cobb, for a bit more philosophy and context behind the improvements. So we'll turn it over to you, Deputy Administrator Cobb.
Thanks, Houston, and thank you everyone for joining our call today. We're really excited to be able to share information about a rule that we've been working on for quite some time. Do want to share that our Administrator, Zach Ducheneau, certainly wanted to be here today, as well as our Associate Administrator, Steve Peterson. Both of them strongly value the relationship we have with lenders across the country. Unfortunately, they both are outside of DC on other commitments today. I'm sure Zach would want me to share his appreciation with lenders as well for your patience and cooperation as we've worked through the IRA process. I know he likes to express that appreciation anytime he does have a chance to talk to lenders. But this rule that we're going to be talking about today is really designed to provide some flexibility and options to our applicants and borrowers. And it's really designed to align with the assessment that we've been doing for years when we first start working with a direct loan customer. That assessment is supposed to be looking at the goals and objectives of that producer, where they're trying to go. Are they trying to expand? What are their future plans? It also looks at the how adequate their real estate equipment and other resources are. And then we should be working with them to determine how are we going to help them achieve those goals, whatever they may be. So that's really what this rule is intended to do, is to give them some options that they have the opportunity to have more of a voice in the structure of their loans with FSA in a manner that's going to help them meet their objectives and goals. What it's not intended to do is create any competition with other agricultural lenders in the community. We think it is going to strengthen our partnership with you, because by giving them more flexible repayment on their direct loans, that's going to help. And some of the changes you're going to be hearing about with releases of security or taking less security is going to free up security so that those producers can be working with you and other lenders in the local community. We do know that, getting a major change sprung on you is kind of a bit frustrating and creates some anxiety. Same thing with our employees. Because of the way the federal regulations work, we were not able to share anything in advance with our field office employees. So our state and county office employees are receiving this information just like you this week. So I would ask that you exercise a little patience. Obviously, as you read through the rule and learn more about it, you're going to have some questions. Many of our employees are going to have those same questions, so it is going to take them a little time to become familiar with it. We do have some ongoing training occurring this week, some virtual sessions this week and next week with our employees across the country. We have some in-person training scheduled for the week of August 19th with our state office staffs, and then they'll go back and be doing training with their local staffs after that. So again, if you could exercise a little patience, we're certain that everybody's going to have a lot of questions. The other thing we know is there's been a lot of coordination with this rule. Not only to be ready for this, not only did we have to write a rule to make the changes in the Federal Register and the CFR, but we've also had to develop handbook changes. We've had to update forms. We've had to work on our FLOT training, prepare for all the training that we're doing with our field office staff. So there's a lot of pieces that go into this, and undoubtedly, as hard as we've tried, we're probably going to miss something somewhere along the way. So I would ask, as you if you see some challenges or problems, be sure to alert your local office or let us know. We are interested in getting things fixed as quickly as possible. I'm hoping that there isn't much to be fixed, but undoubtedly, with something the size of the scope, there's going to be something that did get missed. We did see, when we did our streamlining back in 2007, when we moved, basically after the FSA was created, it took us a while to move everything from the old Farmers Home Administration. We saw a lot of anxiety from staff and lenders at that time, but we did quickly see that everybody adapted to the changes and really found that the changes were beneficial. So let's go ahead and talk about some key dates. So I think as Houston's already mentioned, the rule was published in the Federal Register today. It went on public inspection yesterday. There is even though the rule will be effective on September 25th, so we have tried to put an effective date in the future. Again, knowing that everyone, the public, producers, lenders, county office staff are just seeing this rule this week. So we do want to have time for people to become familiar with it before the effective date of September 25th. It is published as a final rule, but it does have a 60-day comment period. That 60-day comment period starts today, and it ends on October 7th. And then some key themes of the rule, where we're trying to provide some financial freedom to our customers, to let them have more of a voice in how things are structured and how we can better assist them. We want to give them some additional opportunities in the way we assist them. And the goal is to really increase their resilience so that if somebody does have a natural disaster or price of fuel goes up or the price of fertilizer increases, price of their commodity drops, that we don't have somebody that's already in need of some type of loan servicing because they're unable to meet their financial obligations. So we are looking at what you're going to hear about are ways that we can build into the cash flow operating plan, ways for them to create some savings, whether that's for a rainy day fund, capital expenditures. Maybe they want to contribute toward their retirement savings so that they're able to transition at a later date in life. And then we lastly just want to make sure that we are providing equitable access to all of our customers. In looking at the changes we made, we really did do a very thorough analysis of years worth of data that we have on our customers. So all of these changes were driven by data. We looked at the impact and have determined that these are going to be beneficial. And then you're going to hear about some common sense changes as well, things that just logically make sense to do. With that, Houston, I think I'm going to turn things back to you to start giving an overview of the rule.
Thanks, sir. Yep, we'll jump into the changes. Appreciate your comments on there, and I just echo the appreciation that Bill shared with y'all, and likewise, just validate. Yeah, we're here to work together, to partner together, to help our farmers and ranchers out there, and everything in this rule we think strengthens that partnership and enhances that. So, again, you'll want to maybe spend some time reviewing the rule in more detail, but we wanted to highlight the specific items you as lenders may be most interested in. I see that we did get the link to the rule itself loaded in the Q&A. If you want a direct link into the rule, again, it's pretty lengthy, but that is the actual text of the rule. There's three major changes that been highlighting, and you saw that referenced in the video we played. But those really heavily affect the direct loan program. We're going to talk about those in a moment, but first, for this particular group of partners, we wanted to just highlight some important changes specifically directly to the guaranteed loan program. So let's tackle those first. And you'll see them here up on the screen, just kind of summarize 1, 2, 3. And we think these are kind of the three that maybe have the biggest impact directly to the guaranteed loan program. So they've been made after a lot of significant input from lenders and customers and staff. So we're pretty confident they're going to open up some important opportunities that you as lenders have been asking for. First, it extends the opportunities to receive the subordination to allow for refinance of a lender's own debt. Historically, a lender could always work with us to receive a subordination on a new guaranteed loan if they were refinancing the debt of another lender. But that same opportunity didn't extend to if they were refinancing their own debt. So this change is going to remove that unnecessary competition and really enable y'all to give your existing customer just the credit needs and workout opportunities that they need to be successful and keep that that local relationship strong. The second piece here is along lines of just providing flexible options that are needed just to make sure a customer can be successful is, we're removing this requirement that a lender must take a lien on all assets in order to restructure a loan when that restructure includes a balloon installment repayment plan. So, of course, the loan will need to have security, but a lien on all assets won't be necessarily required. So this should, just expand those opportunities for you to restructure loans that are in distress, and all options will be on the table for a customer, including a balloon if you all deem that necessary, and you won't have to avoid that option, or the customer won't want to avoid that option just on the basis that they might have to put a lien on all assets because the FSA regulations would require it. So some important flexibilities there to give options for folks to be successful in-house with their existing lenders. The final piece here is addressing some recent instances of transfers and assumptions that were completed of existing guaranteed debt to non-eligible individuals. So this doesn't happen often, and even when transfers and assumptions are pursued, usually they're not much of an issue at all. But occasionally, without FSA being involved in that process a little sooner, we've had instances where a transfer and assumption was completed by the lender, but ultimately the guarantee was transferred to a non-eligible individual or entity, and that just causes issues with compliance of the guarantee. So we're avoiding that going forward. Make sure those instances don't happen in those rare times where we want to pursue a transfer and assumption, or the lender would like to do that. And you just bring FSA into the concurrence process of that request earlier to ensure that those guarantees stay fully in compliance. So those are really the three specific notable guaranteed loan program changes. But really the most notable changes in this rule affect the direct loan program. And they include the establishment of a new low interest installment set aside program for financially distressed borrowers, the Distressed Borrower Set Aside Program, DBSA, reducing loan security requirements that will ultimately enable borrowers to leverage their own equity and their own assets. And in the last suite of changes, it revolves around providing applicants equitable access to flexible repayment terms so they can increase their profitability to build working capital reserves and savings. So we're going to dive into each of those three a little bit more here. Got a slide on each of them, actually. And so the first change here we're noting is that DBSA, and it was modeled after that successful disaster set-aside program that FSA's maintained for decades. That's called DSA, the Disaster Set-Aside Program. Most of you all have experience with that. That's where FSA has provided for relief of temporary financial distress by deferring an upcoming installment to the end of the loan, at loan maturity. That's been a popular option for folks to cure short-term financial distress, but it's only opened up historically for those who have been impacted by a natural disaster. And so what this new program does, Distressed Borrower Set Aside, is it opens up a very similar deferral program for direct loans, but you don't have to have been affected by a natural disaster in order to qualify, in order to open up the opportunity for the deferral. You do need to be financially distressed, as demonstrated, just like you would for DSA or for primary loan servicing. So if you can't make the upcoming installment, now this DBSA may be a solution for a customer if all that is needed to resolve that distress would be deferring the payment to the end. That's not the solution for every customer. We understand that, but we understand that it can be a viable alternative to our existing servicing options through primary loan servicing, which can be a lengthy application process at times. And another reason folks will gravitate towards this program to resolve temporary financial distress is the payment that's deferred to the end of the loan will carry a reduced interest rate of 1/8%. So one last thing I want to note on this particular change, though, is it will only be available to those loans outstanding as of September 25th, 2024. Again, this is a direct loan program, a direct loan deferral program, only available to loans outstanding as of September 25th of 2024, the effective date of the rule, as Bill mentioned. So we are looking at options to try to expand this program into for all loans going forward, but at this time, and when we have the rule go live in September, will be just for those loans outstanding as of that date, September. You know, our new loans are going to be able to enjoy a suite of additional security changes and repayment term changes. So while the DBSA option may not be available at this time for loans made after September 25th, 2024, they will be subject and be able to take advantage of these important changes that should help free up cash and collateral for producers. So, you know, just again, following this theme of creating financial freedom and opportunity, as Bill mentioned, is just expanding the ability for a borrower to access their equity to further grow their business. And that can be done, you know, without a slick new loan product. You know, we could do that simply by reevaluating the collateral requirements for our direct loans. And, you know, after decades of FSA requiring significant additional security and all available assets in the event of a restructure, what FSA is doing now is limiting those security requirements for most of our direct loans. Now, all loans are still going to be fully secured, of course, but the changes, again, are based on how much additional security is required. So a suite of changes along these lines. First and foremost, and one that was mentioned in the video, was we're reducing the loan security margin requirement down from 150% of the loan amount to 125%. So that means applicants will just have to provide half of the additional security previously required. You know, these are data-driven decisions that are being made. We've got mountains of data, decades of data that reflect that 150% security margin is not necessary for us to maintain superior and strong portfolio performance. Reducing it down to 125, it's able to maintain that delinquency performance without and not jeopardizing that performance at all, while giving the borrower more access to their own equity. And they can use that to leverage for other investment opportunities, maybe future loans with commercial lenders. But the point is, it's their equity that we just probably have heard too many times over the decades, that we just tie everything up, and it's not necessary for us to tie all that up on our direct loans. Maybe we're over securitizing. And this is a reflection of that reality and what the data bears out, that yes, in fact, it would appear that oftentimes 150% was more than was required to adequately secure our loans. Also mentioned in the video was the removal of the personal property being used as additional security for loans. That's not necessary any longer. So we will no longer be taking the primary residence and up to 10 acres as additional security. A lot of nuances there, but I just want to highlight again, if we're writing a loan to purchase a primary residence, purchase a farm, then we will of course require a lien on that property. But if we were only taking it as an effort to meet additional security requirements, that won't happen any longer. We're removing the need for additional security for microloans and farm ownership loans, where the applicant provides a 5% cash down payment. Kind of mirrors similar requirements already in existence for down payment loans and microloan term loans. And again, for primary loan servicing, we're reducing down to just a lien, from a lien on all assets necessary for a restructure, down to just 125% security margin. And importantly, after a series of a few years of a customer repaying as agreed After 3 years of successful repayment, then we'll work with the customer to reduce the security that we have on an outstanding direct loan down to whatever's necessary for us to maintain 125% security margin on the remaining principal balance. So that again is going to kind of have us reevaluate, recalculate where we're at from a security standpoint for those loans with a successful repayment track record, and free up even additional security for them to leverage and make investments in their operation. So, that's access to equity that would have been tied up as collateral is going to be just critical for our customers to grow. And we know it's critical to help them recover from disaster situations or just market volatility. So we view these as real positive changes to enable our customers to grow and overcome adversity. So the last change I wanted to highlight was also mentioned in the video. We'll just start by saying, hey, saving for the future is essential. We all know that, and there's probably few things that are more valuable than saving early for future needs. And there's a lot of programs that manage risk out there, but we're of the firm belief that the best risk management tool is going to be actual cash money in the bank. For some needs, like retirement, saving early means the ability to capitalize on compounding interest. And that's probably something I'd imagine most of us are banking on to be able to retire ourselves eventually. It's that compounding interest factor. But, farmers and ranchers obviously got these same needs too. But a lot of times their only retirement option is to access the equity in their land. And that, as we all know, we've seen that too many times, just stifle generational transfers. And it's been the end of too many farms. So it's just that too often the ability to make strategic investments doesn't come from dipping into the reserves or savings accounts. It's having to call up the lender for a loan. And listen, obviously credit to meet essential needs is an important part of many farms. All of us here whose lives revolve around ag credit, we understand though that the end goal of all farmers and ranchers isn't more credit, isn't more loans, but self-sufficiency. And when we put customers first, by means of promoting these opportunities for farmers to start saving now for long-term financial goals, I think really shows that we're serious about what's best for the customer. In a nutshell, the changes related to our program in this rule for direct loan repayment terms is going to allow direct loan customers to budget for a reasonable amount of savings in their farm business plan. And that'll mean expanded access to unequal repayment terms and interest-only payments for most term loans for the first year of a loan. And we're also going to offer a maximum number of years statutorily authorized to each customer. That'll, borrowers, of course, customers can choose to have a shorter term or pay it off faster with no prepayment penalty as always, but we're going to be consistently providing equitable terms across the nation now for all of our customers. And really, it's putting the power back in the customer's hands to choose, make an informed decision of what repayment terms work best for them. Historically, maybe it's been oftentimes we've provided equally amortized installments over the shortest period possible on our direct loans. This is going to change that reality and give customers more opportunities for flexible terms during the initial years of those loans, really to jumpstart savings and make for stronger customers and depositors that are better positioned for long-term success and graduation to commercial credit. We think when we combine those educational resources with those flexible loan terms that producers are going to be able to make their operations a lot more resilient and profitable long-term. So, the changes in this rule, I've mentioned just how it should free up significant equity and cash. A lot of customers save times on the servicing side of the house as far as having less financial distress. And so, we do anticipate this to have a significant impact annually. And that's just what's being demonstrated here on this slide. The proof will be in the pudding, we understand. But when we put customers first and trust them to make decisions that are best for their personal operation, I believe that's the role of this program. And, to support those customers in achieving their actual needs, their long-term needs. So with that, I want to actually transition it over to Deputy Administrator Cobb to give us a couple more thoughts and to close us out.
Thanks, Houston. So, as Houston's talked about, it's really, changes in the repayment terms. Our goal and the summary of the impacts, what we really want to achieve is our continued partnership with you as lenders. We want borrowers to be able to accumulate a reasonable amount of savings, whether that's for retirement or education, or to support their growth of their operation. In other words, we just want to give them the best opportunity to achieve their short and long-term goals and be successful. I would encourage you as lenders to reach out to your local FSA office as you're working with customers to see how we can partner with you. That may be through guaranteed loans or participation or down payment loans. Hopefully, as a result of some of the changes with loan security, maybe there'll be less interaction in the form of the need for subordinations and some of those types of activities. We do want to work with lenders, whether that's through guarantees or participation type loans. That we want to have kind of consistent cash flows, that we're all basing things on the same thing. And we think that some of our changes probably are in line with what you as lenders are already doing, that we want to have a little bit of a reserve in there rather than, historically we could go all the way down to $1 as long as it worked by $1, or, even out, we could make a loan. Well, that does put a customer in a very precarious situation. So we think our changes are probably in line with what you're already doing as lenders. We have developed some tools. Obviously, we've talked about customers are going to have some decisions to make. We're not going to make that decision for them. We're going to present them with some options. We're going to help them understand what the outcomes of those options are, what the financial impacts are. There might be some immediate savings in one structure to give them some cash up front, but then that probably is going to result in some increased interest costs over the term of the loan. So we want them to fully understand what the impact is as they're making these choices. Again, I want to stress that we see you as our partner. We are not trying to compete in any way with commercial lenders. That is not the goal of this role. The goal is to help farmers succeed, and we just really want to work with you as we implement this rule to really help producers across the country be successful. Houston, I guess I will add too, as you mentioned, this rule does focus pretty heavily more on the direct side. We have been listening to the concerns that we hear from lenders. We are continuing to evaluate options on how we can possibly improve processing times, how we can simplify processes. We certainly need to improve our online services to both producers and lenders. So that is something that we are continuously working on as well, and hope to be sharing more with everyone in the future about our initiatives and accomplishments in that arena. Houston, we did have one question in the chat. I don't know if we want to try to address that. The question was, I don't know if you saw that, but the question was,
Yes, sir. I think I saw it was a really great question about when are these, if a loan was approved, say September 1st, or submitted September 1st, but didn't get approved or obligated till after September 25th, which requirements come into play? And we did provide a response in the chat to the group on that particular question, and the approval date of the direct loan or loan guarantee is the determining factor on what regulations are applicable. So it'll be the date of approval of the direct loan or loan guarantee.
So there's another question about if we can no longer approve cash flows that are just a hair positive, and that is not the case. We have not changed our policy. You do not have to have a specified reserve. That is just an option that we, where that is possible, we do want to have the borrower or applicant have that opportunity to understand that that is a possibility. So this will not, the changes in this rule are not going to increase the number of loan denials for any direct loan applicant. And then I did see there's also a question about the global limits. Limits for direct and guaranteed loans are addressed in the Consolidated Farm and Rural Development Act, and it would take legislation probably in the form of a farm bill for any change in total indebtedness to be modified. So that is not something that would be in this rule.
Well, that takes care of the questions that were submitted. And as you get your hands on the rule and you work your way through it, I'm sure you'll have additional questions, and you're welcome to reach out to your local staff, state office staff, or headquarters relations to get those questions answered. But we're excited about these changes. It is open for public comment. The rule is at this time through the formal Federal Register comment process. If you'd like to take advantage of that, again, September 25th will be the effective date of these changes. And sir, I'll let you have the final word in closing us out.
Well, again, I just want to thank everybody for taking the time to join us this afternoon. As I said, we're very excited to have changes to our policies that we think are going to be very positive for both producers and our lending partners. And we look forward to working with you as the new policies take effect on September 24th. Again, as Houston said, if you have comments or concerns, please take advantage of the fact that comment period is open, and you can certainly reach out directly to FSA as well.